Hi guys, welcome to Estimated Taxes Made Simple for Business Owners. I'm Sadia. I'm a psychotherapist, a tax professional, and mental health consultant. I work with secured financials and I work with a lot of entrepreneurs and small business owners like yourself. And one of my goals is not just to help clients throughout tax season with the preparation of their tax returns but also to stay on top of their business finances without getting too overwhelmed or blindsided by the IRS. So, a little bit of history about me. Um, like I said, I'm a psychotherapist. I do have my own business. I run a small private practice out of Florida in Tampa. Um, I'm also licensed in New York, and I've worked in many different fields. I started off with wanting to be a lawyer, and then I went into the fitness industry and worked in social work with the nonprofit sector. So I've been around many different business structures and have seen different businesses operate their financials. And it's always been very curious to me to see the way the money tells the story. And so that's one of the things that keeps me very intrigued by this work and also inspires me to work with other business owners to tell their story with their finances. And so today's story is going to be about estimated taxes. And so some of what we're going to walk through today includes what estimated taxes are and why they matter, who has to pay them, when and how to calculate what you owe, how to make the payments, what happens if you miss a deadline, and other tools and tips to stay on track. We're also going to go through using a worksheet to actually show how to calculate taxes, either taxes, come tax time to calculate you owe, or calculated to use to estimate what you may owe based on budgeting and so forth. So it's a very versatile tool that is really, really helpful. And so let's start simple, right? What are they? Estimated taxes are payments that you send to the IRS for income received that you have not already paid taxes on. As business owners, it's not automatic that taxes will be paid. We have to manually do them. When you have a W-2 job, when payroll is run, taxes are taken out automatically, but we're not, as business owners, always going to be a W-2 employee. Um, so that's what they are, right? So actually, let's go back to that screen because I just want to name that one of the things the US tax system is, it's based on a pay-as-you-go system, right? So as you earn, that's when you pay. So that's why we have these four deadlines that I will get to, are quite important to stay on track with because it aligns with the way the system is built here in the United States. Now I'll go on to the who. So there are three main groups of business owners, businesses that are required to pay quarterly taxes. The first are your sole proprietors, your single member LLCs. This is because whenever you're collecting monies, whenever you're providing services or selling something and money's coming in, there's no tax being paid on that. So there has to be tax paid on that. You are responsible for paying both the income tax and the self-employment tax in those quarterly taxes. And it's required if you expect to owe more than $1,000 for the year. The next group is the S Corps and the partnerships. So those are the businesses where you may have payroll and there are going to be some taxes that get taken out in that payroll. However, there's also monies left over post expenses, post payroll that after the business owners, we just, we take it out because it's ours. That money also has to be taxed. So that's where the quality taxes will come into play in that arena. Um, a lot of the time, S Corp owners, partnership owners can forget that or don't realize that that's actually necessary. And so come tax time, when the bill comes in and they're like, wait, I owe this much, it's because that piece was missed. And then you've got freelancers, contractors, your gig workers, right? Who often will use platforms like Stripe, Square, PayPal. None of those withhold taxes. They give you a 1099, and then it's expected that you will pay the tax on the money made. So it's really, really important, helpful to set aside a portion for taxes whenever you're receiving monies from third parties, or honestly, in general. When do we pay? Quarters, four of them, right? So for Q1, we pay at regular tax time, April 15th, and we're paying for January through March. And then Q2, even though we're paying through the end of June, we are paying June 15th. And so it will equal the correct amount because when you calculate June 15th to September 15th, it will include the rest of that June monies. So that don't need to worry about why it hits in the middle of June. But that's when you pay Q2. And then you have Q3, which is September 15th. And then Q4, you actually pay the following year in January, on January 15th. One thing that's important to include when you're giving your tax preparer or your accountant all your documents for the previous year for your tax preparation is to include that Q4 payment for the previous year. Even if you're running on a cash basis, it's still money that's being applied to previous year's taxes. So they do want to be reported on your return. Fun fact, IRS can and did actually with someone in this room register that a Q4 payment had been made, but I completely forgot to include it in my on my tax return, and they adjusted my refund to include that payment also that was made. So the IRS do pick up on things sometimes, but I still would err on the side of making sure you get all your ducks in a row. Okay, so how do we calculate them? It seems like a simple-ish process, and I'll be honest, if we have bookkeeping in place and you have a great system to track income coming in, expenses going out, distributions being made, then it's really, really simple to find the numbers you need to plug in to the spreadsheet we're going to work with to be able to calculate how much you owe. So here's some of the suggested rates if you don't have the calculator or for whatever reason. To err on the side of caution, most self-employed people, regardless, and it varies state by state, but it just, well, for state taxes, for federal, it's generally safe to put aside 30% of your net income, right? So if you put aside 30%, that will be that estimated tax rate. So it's that net income. So it's money's left over after payroll if you're an S Corp partnership, after all your expenses if you're a single member LLC, or a gig worker, right? What monies that you're left with, a general rule of thumb is 30%. If you have a W-2 job and you're running a business, then that number goes down a little bit to 25% because you're having some taxes taken out in your W-2. And then you've got your S Corp businesses that do run payroll. Those are taxed slightly differently, their tax rate. And you've got your taxes coming out from payroll. So those tend to be safer at the 50 to 20%. These are just general guesstimations. That's how you essentially calculate it. What happens if you miss a payment? So if you miss, then the IRS can technically charge for penalties for missing a deadline, even if you pay in full at tax time. It doesn't happen super often, but honestly, the way the IRS changes its operations, the ways in which administrations change, it's better to 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 pay than to even be in a position where the IRS can come after you. So that is allowed. The IRS can do that. Um, can seem small at first because it's like, oh, Q1, it's fine, I'll pay Q2, oh, Q2, Q3. One of the things about the IRS is that they are very uh, quick to add interest on any monies paid and late fees and all the different ways in which they can collect additional money. And those can add up over the months. And that stress of not knowing can stay with you. So it really is so much easier and more seamless just to keep the calculations, pay the quarterlies 4 times out the year. And so that's not going to be a thing you have to worry about. And also come tax time, you're not worrying about what your tax return will look like. Okay. Some of the common mistakes. So even with the best of plans and with solid intentions, these are some of the ways in which we have seen. I've seen things kind of go a little bit uh, wonky. So one of the things that I've seen happen is folks will sometimes be putting the money aside and feeling, okay, I've got it aside, I've got it aside, I've got it aside, and then pay by the end of the year, right? And sometimes, especially for businesses that make different amounts of money throughout the months, we can miscalculate. Right. So it's too late to fix or spread out that cost. If you get to Q4 and you owe a ton and you don't have it, then it's a little bit of a scramble. So it's better to be paying throughout so you know it's safe and so you know you've hit that number. The other thing that sometimes comes up is folks will use the wrong numbers. So they'll use a gross income versus the net income, which then messes with the numbers and it makes it too high. The other is those who don't set aside the monthly payments and they are then scrambling at the end, hoping, oh, I'll just, I'll get it at the end, I'll get it at the end, I'll make up for it. Sometimes that doesn't happen, and then we are scrambling and it feels very, very stressful. And the other is that paralysis piece where we just don't pay anything at all, right? I'm going to do it wrong. I won't know what the number is. I'm just paying zero. And then I'll just have my accountant or my tax preparer kind of figure it out. And I mean, we will, right? We will prepare the return. We'll get the number that's owed, and then there are ways to pay that money. But there's such a process. Anything with the IRS is such a process. It's far more beneficial to just pay it at the time it's due. The other one with S Corp owners that I've come across is that the assumption that payroll covers everything, and then forget the distributions. That's the money leftovers, and then are surprised at having to pay taxes on that money. So these are some of the common things that come up. The truth is, though, doing something is better than nothing, right? So even if you've paid a little bit, even if it's a rough estimation, even if you don't have any clue what the number is supposed to be, throw something in every quarter. At least that way you can show the IRS that you've made a good faith effort. Okay, so these are a couple of tools that you can use that will help with setting up a system that will make this a lot easier. So one is the Profit First book, and then the other is Relay Bank. Now let me explain why both of these are game changers. Profit First book is a business staple. It's right up there with Rich Dad, Poor Dad. And if you've ever struggled with paying yourself or managing cash flow or feeling like your money disappears, this is the book to read. It's going to completely change how you think about business finances. One of the things it does is it helps you organize the different ways in which your money is distributed throughout as you're earning it. So you don't have to think about, I need to put it in this, I need to put it in this pot or this pot or this pot. And this is where Relay Bank comes in because it's an online business platform that's designed with the profit first model in mind. So it's free to open the accounts. It allows you to open 20 different checking accounts and multiple physical and virtual cards. And the best part is you can set up automatic transfer rules. So your income is going to get split into your tax pay, your profit, and your expenses bucket, and you don't even have to think about it. So these two tools will really help to establish a good system to help with the quarterly taxes payments. Okay, so now it's time to work. So I'm going to pull up the spreadsheet that we are going to use so I'm going to stop sharing here. And I'm going to very quickly just pull up this spreadsheet. And we are going to practice using a handy dandy tool. Okay. And I'm going to share this with you guys. Okay. So you should all have this spreadsheet, and it's what you can use to help calculate what you might owe. So we start off with the personal information. So this is going to help establish what your standard deduction is that you'll see down here later on. So depending on how you're going to file, you're either going to file married filing joint, in which case the numbers you enter has to include both you and your partner. It might be married filing separately, head of household, single, or qualified surviving spouse. I'm going to go ahead and just put head of household. And then if you're over 65, you're going to go yes. If you're not, you're going to go no. Spouse over 65, yes or no. This is just important because it affects the standard deduction depending on age. So that will populate down here depending on what you put up here. So then we go to the income. So we have your personal income. So you're going to put in your wages. These are your estimated salaries, wages, and bonuses reported on your W-2 for the entire year. Great. So if you're going to do for the entire year, you're going to put the estimated number. If you're calculating for Q1, you're going to look at your paycheck and you're going to look at year to date. Right. That's what's going to help you figure out how much you owe for that particular quarter. Then you're going to do interest and dividends, which is if you have savings accounts that you gain interest on, or different other investment accounts. And then you've got your capital gains. These are going to be your stocks, your shares, anything. If you do trading, that's where that is going to come into play. And then your other income. So this here, for those who have S Corps, this is going to be where you put your net income, right? So if you do have bookkeeping, you run your profit and loss, you look at your net income, and this is where you plug that number in. If you don't have a profit and loss, you calculate all your income, you minus the deductions out of it, including payroll, all of that. What you're left with will be your other income. And then that's going to give you your total personal income. So if you're not an S Corp and you have a single member LLC or a sole proprietorship, this is where you're going to put that money in. You're going to put your gross income, you're going to put your business deductions, and then that will be your net business income. Okay, so then we go down to any additional income and adjustment. If you have unemployment, you're going to put that here. If you have a real estate property and you're getting income from there, that's where you're going to put the number here. Quick point about your net rental real estate income. It's net rental. So it's your gross rental income, and you're going to minus out the expenses you can deduct. So those include maybe HOA fees, those include property taxes, those include interest on the mortgage, not the mortgage itself, homeowners insurance, all of that. So what you're left with will be the number that goes in here as income. If you have student loan interest and educator expenses, these are other deductions, adjustments to income. You would enter that as a negative number. So then the spreadsheet knows to minus that out. And then you have other income here, which is kind of similar to your other income in 15. So you could place them either place. Here, other income could also be if you have distribution for your retirement account, for example. All of the white boxes self-calculate. So this will calculate the self-employment deduction that comes into play if you have business income. And then so your total adjustment to income will show on row 30, which will then give you your adjusted gross income here, summed up at 32. Then we get into the itemized deductions. And so when you're doing your tax returns, you can either itemize your deductions or you could use the standard deduction. Most of the time, what I see is the standard deduction, depending on your filing status. If you're not sure which is going to be more, you can always plug in the numbers in the yellow boxes, your state and local income taxes, your real estate tax. This is for property that you own and live in. Personal property tax, mortgage interest, charitable contributions. Other itemized deductions would be healthcare. And if you're not sure, then the spreadsheet will calculate and use the highest number. So it's really up to you. And then it's gonna calculate for you down here what your taxable income is. So your AGI, as you see here, it's the 105. These are just example numbers, 976. And then there's the standard deduction of 22,300. And then you've got the qualified business income deduction. That's a harder one to calculate. And honestly, the way that I tend to think about estimated taxes is if you're doing it throughout the year, you want to err on the side of slight caution. And because the QBI changes each year based on tax code, it's really hard to know what it's going to be. So I don't even include that. And worst case scenario, you're going to pay a little extra and you'll get that refunded back. So it's in there if you are super handy dandy and can calculate your QBI. If not, it's not going to be a big impact. It's not going to be a deal breaker, right? You're still going to be paying and being in compliance with the IRS. So then you're going to get the calculation of your taxable income. That's going to be down here, line 47. So the tax calculation then comes into play. So you've got the income tax will populate how much you owe, the self-employment tax will owe. So this is the total amount of tax that you owe based on these numbers. You'll put in some of the tax credits here. So we've included some of them. If you look in the next tab that says helpful tax information, you will see some explanations about the spreadsheet, but further down here, you'll see some of the common credits. And so you'll see that right now, the child tax credit is $2,000 per qualifying child, with the $1,700 being refundable. You have the adoption credit here if you've adopted a child. You've got the earned income credit here, which can vary, and because the income thresholds do apply. And then you've got some other credits there. You don't have to put them all in. I tend to just, again, child tax credit is usually the easiest because it's the one that is likely to stay stable by the time tax time comes in. So that's 2,000 there, say for one kid. And then you want to look at your W-2s if you have any, and you want to include the W-2 federal taxes you've paid for the year so far. And it'll be on that W-2 or it'll be on your pay stub if you're doing it before the end of the year. And then you're going to have your other withholdings and tax payments. So these are your quarterly payments that you've already made, right? So if you're trying to calculate Q3, but you've already paid Q1 and Q2, you're going to include that here. This is where you get that number. So here, this particular example, the tax liability here is 7,942. So that's how much they owe on these numbers. Now down here is a box that you can use as a way to avoid penalty. If, for example, you get to the end of the year, you haven't paid any taxes, and you're like, oh, okay, now I need to figure out what my first, second, third, fourth payment should be. So this is just very helpful to get an overview of the entire year. If you're budgeting and you want a sense of, okay, what would my first, second, third, fourth payment be if this is what I owe? So it's just a helpful kind of way to get an overview. So that is the tax calculator estimator. Really, really handy. I'm going to switch back to myself and switch back to the slides. Okay, so now we did that. We would typically open the floor for Q&A. And here's some of the questions that come in. What if I don't make an estimated tax payment? And now the calculator says I owe more than I've saved. That's when you would use that box down below and make sure that you're paying, to the best that you can, up to that 90% that box shows, or the breakdown of the amounts. So that's where that gray box at the bottom is really helpful. Okay, so here's what you can do. Firstly, don't ignore it. The longer you delay, the worse the penalties can get, and they can build up. Two, make a partial payment, pay something. Anything is better than nothing. And like I said earlier, it does show the IRS that you're in good faith, right? Three, plan for the rest of the year, right? You can spread the remaining payments across future quarters to ease that burden, especially those of us who know we're going to make less, say, over the summer than in January. If you pay a bit more for Q1 because Q2 might be quiet, go ahead, do that, right? And if you're really unsure, talk to a tax professional. We can guide you, we can help set you up. I mean, we can even do it for you, but knowing how to do it is really, really helpful. And then if you are going to owe a lot, we can help you with strategy, right? A lot of the time, people's W-4s, their withholdings are not quite accurate. They don't accurately represent what the situation is. If you've got multiple jobs, each job doesn't know what the other job, how much the other job is taking or paying. So they're just going to tax you based on that. So sometimes when there's multiple jobs, multiple streams of income, there's some confusion around, okay, how much should be going out? That's where we can come in and help you with that. Okay, that's our presentation. I hope it's been helpful. And we've tried to kind of give you a general overview in the beginnings of what it looks like to be able to manage your estimated quarterlies. If through any of this information you've realized, oh gosh, I need some help with my bookkeeping, how do I make sure I'm set up so come tax time, it's a really seamless process and I'm not kind of scrambling for all my documents, then reach out to us. We can definitely help you. That's what we're here to do. Thanks so much, and I hope to see you soon.